Hey, good afternoon, everyone. This is Sam, and I'll be kicking off the state of the market for June 1st, 2020. So, first time doing the stream here like this, so let's just make sure we're all good here on the audio visual, and we'll get started. Okay, looks like we're all good. Thank you very much, Miss Julia, Mr. TG. Thank you much. All right, good to see you, Golden. Awesome. So it looks like we have video, looks like we have sound. I'm just going to trust it and just go with it. So let's talk about some markets here. And if you guys have any questions, just put them in the chat. We'll come back to those here in just a second. Since it is called the state of the market, I do want to focus on bigger picture stuff with you. If you were in the gold session this morning for the open, then you've seen some of this, but I want to share it with everyone here. So let me show you a couple things here that I'm seeing. Now, the state of the markets are strong here, undoubtedly strong, probably a lot stronger than most people would have expected. Let's actually kick it off here with the Qs because the Qs have been the strongest market. And I think I'm going to show you something pretty cool here. So this is the Qs. Usually I have my charts here on a daily, 195, 130, and an hourly. So this is the common view that you will see from me. What I'd like for you to focus on here with the Qs more than anything else is just the previous high right here, 237 and a half, and the fact that we're trading below it, right? Now, with the Qs, more than any other index, they have rallied almost back to their high, a lot more than every other index, right? So the Qs are the strongest sector or index, right? So all you have to remember is that high there, we do not have an equal high yet, but it is the most progress out of all of them. So let me show you this. This is something that I made that I call the Fang Index. Fang, F-A-N-G, as in Facebook, Apple, Amazon, Netflix, Google. Now, it's got a lot more things in it, but the idea with this index is that by creating an index of only the things that really move companies, you will find that well, let me just say this: out of the S&P 500, there's 500 S&P 500 companies in the S&P. How many of them really move the market? Probably at most 50, and that's me being ultra generous. In reality, it's probably closer to about 10 to 20. Right? That really tends to push everything, and then everything else just kind of follows. Well, my thought was if that is the case, if 10 or 20 companies out of 500 indeed drive the index and therefore drive everything, then why do I care really about the other 480 companies? And the answer that I came up with was I don't. Very simple answer. So, by making this index, what it allowed me to do is allowed me to remove all of the junk, right? All of the non-Apples, the non-Googles, the non-Amazons, things that just don't move much. And look at the difference here. Here's your previous high before the crash, right? Here's your crash. Here's your previous high, and then look at where you are now, right? You've made it back to the high. So do you see here how the Fang Index is capturing strength better than the Qs? I dare you to pull up a chart of anything major index, right? There's stocks that have made new highs, but in terms of a new index, there's no index that has done this. The reason this is important is because this leads the markets, right? So if you had access to this, you would see, okay, hey, this is back at all-time highs. The possibility that the Qs not only get back to their highs, but potentially even make a new high is rather large here. One more thing I'll show you here. Keep in mind that this chart represents the entire market, in my opinion, better than the SPY, the Qs, the IWM. There's nothing out there that represents the total market better than this chart. Look at what's going on here. This is not a daily chart. This is a 130-minute chart for a reason. I wanted to find something that had a setup and that had trend. And this one, you can see here, you're holding the 21 on this time frame pretty well as support. You have a little bit of a channel here. But you're holding the 21 as support, and check this out. You're right near the highs, the old all-time highs. Very important. I can't stress that enough. And you have a high compression squeeze an upward bias to your momentum indicators. So what is this telling you? Well, it's telling you that the companies that move everything, the 10 companies that move everything, are showing a rather large amount of strength. Not only are they showing strength by being back at the all-time high, but then they still underneath the market with that high comp squeeze and the momentum profile. It still has more room to break through and make a new all-time high. So something that you should be very aware of. One thing that we've been stressing in the room is, and especially with myself, is trying to, as much as you can, avoid the news. And especially now, right? I mean, when have we ever seen a greater rift between the news, as bad as it all is, and the stock market, right? And it seems like the worse the news gets, the better the stock market gets. So if you're watching news, if you're factoring any of that into your trading, it's probably hurting your trading. And sticking to the technicals and really focusing on where the strength is, which is the FANG stocks and tech, has been a way to kind of keep your head above the noise. So I wanted to start there. Let me just show you a couple more things here, because this, if you were with me in the morning, this was, I always kind of go with this. This is kind of like the story of the week that I share with the group. If you're in the Simpler Trading Gold Room, you've seen this. But this is kind of what I thought the story of the week was, and this is where I'm going to segue next. And it's the interplay or the dynamic between the cash markets and the futures markets. And when you have this interplay here of multiple setups on both the cash and the futures, it gets really interesting. And really, those are your best absolute setups. So let me show you what I'm talking about. So if we go back here to the Qs, keep in mind we look at the Qs because they've been the strongest index. Look how good the support on the 130.50 has been. That's almost picture perfect. So check this out on the Qs. Do you have a daily squeeze? No, you don't. But you have daily support in front of your 21, and you have good momentum, right? So no setup there, no big deal. We go one over. 195. Do you have a squeeze here on the 195? Well, you do. You actually do. Now, I've get a lot of questions on what direction will this squeeze fire. Typically, that's part of the game, right? Is understanding what way this could fire. Typically, though, your safest bet is it will fire in the direction of the prevailing short-term trend. Right, so here on the 195 where we have our first squeeze, the short-term trend is undoubtedly up, right? So even if you had nothing else other than the moving averages and just the squeeze, you could reasonably guess that that's going to fire higher most of the time, right? So this is our first setup is the 195, and here's our secondary setup. It's the 130. If you guys are unfamiliar with these time frames, the reason that John came up with these, the 130 and the 195, is because if there's 390 minutes in a trading day, right? And if you divide that by 60, you don't get a clean division. So by doing it 390 minutes, if you want 3 bars per day, 130. If you want 2 bars per day, 195. Pretty cool time frames for sure. But you see here how these two charts right here are our setup, right? And the cool thing is from a trading perspective, the 195 and the 130 when they work together like this isn't usually a quick thing, right? Usually this should last at least 3 to 5 days is what I'm looking for. So here is your setup on the cash. Keep in mind the Qs are different than the futures, right? You want to have both. You want to have both the cash market, which is the QQQ, and then you want to understand what the futures market is doing because that'll help push everything, right? And so the main crux of the idea here is it's great to have a setup on the Qs. It's even better to have a setup on the Qs and the NQ. So let's check that out. So we just looked at 195 and a 130, which is a powerful combination on the Qs. Let's go to the futures markets next. Okay. So very similar idea, right? Very similar idea, but the difference is one, One is cash, one is futures, and two, you're looking at different time frames, but very comparable time frames. So what I would say is this: on the NQ, do you have a squeeze? Well, you actually do. It's a low compression squeeze. This black squeeze here is still counts as a squeeze, but it's the lowest compression and the lowest quality squeeze. You can get good moves from this, but I prefer regular squeezes. So just like we did with the QQQ, which is the cash, we're just going to discount it. We're just going to say that's good enough. There's no issues there. Momentum is still solid. It helps to have a low compression squeeze, but it's not a big deal. Let's go ahead and move over to the 12-hour. Do we have a squeeze here and a setup? Well, we do. We have a pretty good squeeze here. You see how the histogram on the squeeze is pointing higher? As long as that it keeps increasing, basically the histogram should look like this. If that keeps increasing, which so far so good, then that increases the possibility that this daily squeeze will fire long. So there's that. Here's your setup on the futures. You have a 12-hour and a 8-hour squeeze. Keep in mind that the squeezes go for about 8 to 10 bars. So if that were the case, let's use the smaller time frame to project how long this could last. 8-hour chart times 8 to 10. So pretty easy math there. We would expect about 64 to 80 hours of squeeze. So how many days is that? Like 3 days? Right around there, 72 hours or so. So for the next 3 days or so, the Bulls have a rather large advantage, right? And I hope you can kind of get what I'm getting at here. Not only do they have a setup in the cash, which is important, but they have a corresponding and equally strong setup in the futures. If it hits, if it breaks out, it should be good for 3 days. And you have the Fang Index, which I showed you at the beginning of the session, near the all-time highs. That is the strongest group of stocks in the market, and it has a high compression squeeze near the all-time high. Very impressive stuff. Let me show you one more thing here, because it's not just all about um, the cash markets and the futures markets. You also have to understand volatility, right? Because there's one thing that could kind of sneak up on you sometimes, and it's going to be volatility. So this is the third kind of leg of the stool, if you will. Do stools have 3 legs? Do they have 4 legs? Let's call it the third wheel of the tricycle. So next up is VIX. And what you want to see here in VIX, and it's not overly clear yet, but below 26 or so, it gets a lot more clear. Now with VIX here, you have a lot of squeezes. And from these squeezes on VIX, you can get rather large moves. Notice here how on VIX, and this is just the regular VIX, VIX, the cash product. You could look at the VIX futures as well, and I think it's a good idea, but with you guys, with limited time, let's just go ahead and do it with VIX. So with VIX here, in order for everything that we've just talked about to play out, the VIX does have to cooperate, right? And for what that means is that the VIX, keep in mind, the VIX dropping here below support, that would actually be very bullish for equities. If the VIX were to break out here, that would actually be very bearish for equities. As of right now, you see how the VIX has a very large 130 squeeze? It also has an hourly squeeze. It also has a 195-minute high compression squeeze, and it actually has a regular squeeze, right? So we don't have a clear signal here on VIX yet, and it does muddy the water a little bit, right? Because we have a really good signal on the Qs. We have a very solid signal on the Fang Index, which is, I can't stress to you how important that is. We have a strong signal on the NQ, which is the futures, but we don't have a slam dunk set up on the VIX yet. And the reason it's not slam dunk is because everything's so neutral here, right? You see how the squeeze there is flat. The squeeze here is flat. Your momentum is pinned at the 50. It's pretty close to the 50 there, very close there, kind of close there. So since we have a situation here on VIX where we're not entirely sure, based on the indicators alone, what direction the squeeze is going to fire, keep in mind, if you're bullish, you want this thing breaking lower. then what you can typically do, and kind of what I'm doing mentally as a bookmark, if you will, is just saying, okay, the VIX is clearly in a downtrend, right? If you look at the daily time frame over here, very obviously in a downtrend on the via the 21. I don't know what direction these squeezes will fire. I have to side in the direction that they will fire lower until proven otherwise, right? So keep an eye on VIX. If anything is going to sneak up on the market, it should happen here. Now, what I will say is this: below this little bit of support here, right? I'm just going to draw kind of a little support line there, and I think we can all agree that this is your support line. Below it is 26. There's another support. Let's call it 27 and 26. If you start to break below that, I think you have to lean into it and go long the market. However, if you want to be very conservative, then you wait. You wait for a break of this support. Now, why is it conservative to wait for the break of support? Because out of everything that we've looked at, this is the one thing that's not overly clear, and it actually could wash away all the other setups. Now, chances are it will break lower, but if you want to be conservative, that's the way that I would play it. Because here's the thing. Here's your support level, right? Short-term support, but it is support. And then you have another one here. If it breaks here to the downside and you want to get long stocks, it may be prudent to wait for that to happen because of all the squeezes, right? So the idea that this would break lower and stop and go the other way, given all of these squeezes here, very low, right? So we should get a very large move from VIX here, and odds would favor the that it breaks lower. It's important to keep an open mind here because it hasn't broken yet. You do have a couple of higher lows here, but again, there's nothing on this chart that looks particularly good, so there's going to need a lot of work to be done here before it's going to wash away the bullishness on equities. So we'll get to a couple questions here in just a moment. I really just wanted to kind of orient you guys in terms of this week, because if you understand what I'm saying, then it doesn't really matter what you buy, right? Let's just kind of walk through that for a second. So we talked about the NASDAQ, we talked about the QQQ, and we talked about the Fang Index. And now we're talking about VIX. Well, let's say you get a scenario here, given all of the things that we talked about, where you break the low on VIX. What do you do as a trader? Well, given everything that we've just talked about, if VIX were to break lower, you have to lean into it. What does that mean? It means selling put credit spreads on tech. It means selling put credit spreads on the index. It means butterflies. It means bullish trades that take advantage of falling volatility. So in that instance, the best trades for that, put credit spreads, butterflies, things like that. And you'd want to lean into it. There's enough meat on the bone that once you get a directional move here, you do want to lean into it. So then the other thing I wanted to talk to you guys about just briefly is going to be the dollar, because this is a big one. It's not something that I will trade very often. I rarely trade currencies anymore, but they're very important, especially the dollar, especially here, especially now. With the dollar going lower is going to be one of the most bullish things for the stock market. Now, why is that? Why is a weak dollar bullish for the stock market? Well, it's bullish for the stock market because it buoys the entire rest of the world, right? There's one thing that can really hurt the emerging markets that are relatively weak compared to us, right? Let me just show you, right? Instead of just talking, let me just show you the emerging markets here. You see how far away the emerging markets are from where we are? Right? We looked at the Qs. The Qs are up here somewhere. The Fang Index is up here somewhere. And the emerging market's way down here. But they actually have a setup thanks to the dollar. I'm not saying let's play this, but the idea is, all of it kind of comes back to us, right? The idea is if the dollar's weak, that helps emerging markets. If emerging markets get helped, that's one less problem for the stock market. One huge problem was a strong dollar. Let's go back to the dollar. Because if you're an emerging market country, the worst thing that could happen to you is A, a recession, global recession, and then B, a strong dollar, right? You're kind of getting it from both ends in that instance. One, a recession isn't good for any economy. Two, emerging markets a lot of their debt is denominated in dollars, but their home currency might be whatever it is. If dollars get strong, it makes the cost of repaying that debt that much more prohibitive. So they'd be in the middle of a recession, and the cost of their debt would actually be rising. Not a good scenario. You can't fix the recession right away, but if you fix the dollar problem by weakening the dollar, then you take some of the pressure off of the emerging markets, and that's one less thing for the market to worry about. So let's look at the dollar here. It's actually right on support as I have it. Now, again, just to bring back everything here, because I don't want. Usually, when I show folks the dollar or something like that, they're like, "Well, how do we play the dollar?" I wouldn't. I wouldn't. What I would say is, as long as this chart goes lower, this is one more catalyst for stocks to go higher. And that's really the crux of everything that we're looking at is big picture stuff that ties in well together that might drive your Microsofts or your Apples or your Googles or your Netflix or any of those stocks. So real brief with the dollar here. I ran a Fibonacci high to low, and here's my last support of significance, and it's pretty much exactly where we're trading, 97.837 on the Dixie. You have this range here in the dollar that was building up and coiling. It was coiling up in a bullish way, meaning that it was coiling up above the 200, the 100, the 50, etc. And you see here how this coil is starting to break down. You see how it kind of looks like a wedge and it's starting to break lower here. Not only that, it's triggering your daily squeeze. Um, Now, I do want to say this. It is at support, which should give it a short-term bounce. But here's the thing. If the dollar, against what most people believe, most people thought the dollar was going to go higher, if the dollar continues in this direction, that is going to be a huge boon for equities. Equities are going to cheer that massively. So let's just do one more look at the dollar here with a bigger picture point of view. Okay, so nice weekly chart of the dollar. And here's what's at stake. This is why this is so important. You see the dollar here, how it was the squeeze was climbing, 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 and then it starts to reverse, right? At first it flattens out, and then it actually starts to drop. Now you're in a squeeze here, right? You see how the red dots, you're in a squeeze, but you see how the squeeze is forming in a negative fashion? That's not entirely good. You see how these indicators here are negatively positioned where the red line is above the yellow line on both of them? That's not entirely good either, right? So you are at support here as I have it on the dollar, but in the event that this signal on the weekly dollar plays out to the downside, it's going to have a couple of effects. One, it's going to make bonds less attractive, which makes stocks more attractive. It will help emerging markets, which guess what? Makes stocks more attractive. Um, there's a huge amount of implications here. So if you have any questions on this one, feel free to let me know. But you should be aware of what's going on with the dollar there. And just a couple more here, just real quick. I think we covered most of everything. Mostly what I wanted to show you guys was the setup between the cash and the futures market for this week, the dollar and the implications that it has for continuation here. Because keep in mind, and this is kind of maybe subtle or not as appreciated, stocks could go up. Nothing can change with stocks, and they could actually go up in value if the dollar were to drop. Now, why is that? Well, because stocks are priced in dollars. And let's say everything else in the world stayed static and just the price of the dollar dropped, the price of stocks would probably rise a little bit to compensate for that. It's no different than how your grandparents used to tell you. I used to go to the store and buy I used to buy a carton of eggs, a gallon of milk, some bread, and then I still had 2 cents left over from my nickel. You're like, where'd that go? Prices are way higher now. Well, they're higher because of inflation. So inflation has a positive, in quotations, effect on stocks. Um, so let me show you one more thing here. This is an open trade that I have with the room that may take advantage of this dynamic a little bit, and then we'll open up the floor for any questions. Because think to yourself, even before I pull this up, what likes inflation, right? Even if this inflation narrative isn't real, or isn't real isn't correct. Let's say it's short term, right? Because my bias, just to put it all out there, my bias is that this is a short term inflation story that won't actually materialize. My view is deflation overall. But in the event that we start to play out a short term inflation story, in your own mind, what do you think goes up? What's benefits from inflation? Well, there's a couple of things. The easiest one is stocks. Stocks like inflation. So as always, kind of all roads lead back to equities. Stocks would like it. But then you should also think about gold, right? There's two different ways to play interest rates, and I've talked about this in the room. Gold or bonds, right? They're not too dissimilar from each other. They're essentially cousins. Um, if you think about the two things though, gold and bonds, which one of those two likes inflation? Well, obviously gold, and bonds are the exact opposite. They really don't like inflation. So this is kind of a messy chart. I realize that, but I just want to show you the setup here. In gold as a potential play on this idea. Keep in mind, though, that the easier play is still equities, right? It's still equities, but gold makes a lot of sense to me. So just real quick here, you have this large consolidation in gold. You're making higher lows as you go along, and then you have, as I see it, you have a flat top here. And the flat top for me is 1765 or so on a close. So what you can see here is you kind of, in effect, you make a triangle, right? And whenever you have triangles like that, your swings are getting smaller and smaller because you're coming to a point, right? And you're running out of room. And you see how your swings are going to be eventually very, very tiny there towards the latter part of the triangle. Even if you don't subscribe to that, that's perfectly fine. You probably do subscribe to the squeeze. And regardless of whether you look at it with the triangle or you look at it with the squeeze, you get the same message. So what I've been waiting on gold to do is to actually cycle through and give me the same signal across all time frames. And we actually have that now. So on the daily chart here, that squeeze looks just fine to me. There's nothing wrong with it. The momentum signal, you see the cross there? That looks just fine to me too. You see the cross here where the red line is trying to hold the 50 and turn. That looks just fine. The problem had been on these time frames. And I talk about this concept of smiles and frowns. When the indicator looks like a frown, you see it right here, it looks like a frown. Looks like a frown. More like a frown. Those are usually opportunities to sell. But then all frowns, it's like a sine wave, right? It kind of looks like that. All frowns turn into smiles eventually. And now you're on the smile side of the formation, right? And that's what I want to see. That and that. Smile structures. And you have it on both the 12 and the 8 hour. So the idea here at this point is this one was good to go the whole time. It was just a matter of getting these two time frames on the same cycle. What I mean by cycle is just smile, smile. Looks ready to go. So if you want an easy way to play inflation, keep an eye on gold. I think that's one of the more obvious ones. And then maybe less obvious to most people would be still the stock market. Equities love inflation. So aside from that, that's mostly what I got, guys. Just kind of big picture stuff here, state of the market kind of stuff. Aside from that, I'll leave you with XLV has a setup. That's the healthcare space. I still like semiconductors as long as the China thing doesn't blow up, so that still looks solid to me. Emerging markets, like we talked about, which were not looking particularly good with the dynamic of the dollar, are being helped. And all this stuff that I'm talking to you about, see how it all kind of comes to a point? Let's close with this, because this is really the conversation we're having. So let's see, how can we do it? Let's do it over here. So we looked at the QQQ. We looked at the NQ. We looked at the FANGs, which are very similar. We looked at the dollar. That's a big one. And we looked at VIX. And I would say if you understand this, this, well, let's just say all five. If you understand all five of these things, you probably understand everything. You should be able to have a good idea as to the next direction of the entire market based on the positioning here. And you see how everything that we've talked about kind of comes to a point, right? I'm not saying go out there and trade VIX or dollars or anything specifically. What we're looking at after all we look at all this stuff is it bullish or is it bearish, right? And overwhelmingly, we kind of keep coming back to this. So the totality of everything that we looked at, the Qs are positive and could get more positive. That's important. Not just positive, but can get more positive. The NQ positive, the FANGs positive. The dollar is negative, but keep in mind that's actually bullish for the market. That's a positive. And the VIX, here's the big question mark. As I see it, and really the only question mark. Does the VIX cooperate? We have 4 out of 5 things here all telling us bullish. If the VIX were as easy as the others, I would say we just go out and buy everything tomorrow. The VIX gives you a little bit of pause, but you guys have the levels that I talked to you about, and you know the setup. So you know what to look for. 27 first, 26 later. If it breaks, you lean into it, and you buy long. If it doesn't break, then you pump the brakes on any longs and you wait for it to set up again. Okay? So that's what I got. I'm not sure how questions work on this thing, so I'm going to try my very best to get to all of them. And we'll see how we go. And for your viewing pleasure, let me pull up. Let's pull up the NASDAQ. Okay, so if you guys have any questions for me, here's my email. I'll just because this is again my first time doing this, so in terms of the tech, I have no idea how any of this works. I'm surprised it's working at all. But here's my email: sam@simplertrading.com. If you have any questions as to what we talked about regarding pretty much anything, feel free to send me an email, whether you're a member or not. Send me an email and I'll get back to you. But that's my email if you want to get in touch with me. And let me just go through a couple of the comments here. Okay, I have, okay, there it goes. Okay, I have no idea how to read questions here, guys. I apologize. So I'm just going to answer the ones that I see, and if you have any new ones, I think they're coming through. So, hey Sam, thank you for being here. Very glad to see you here, Sam from Orlando. And you know, I personally really enjoyed having you in the room. I thought you were a great addition to the room. You were very helpful. I enjoyed speaking with you. I'm gonna miss you, man. I hope you rest up and you come back soon. What do you see happening with a deflationary environment in gold? Honestly, here's the thing. I see gold working out either way. I don't think that a deflationary environment will hurt gold, and the reason is in a deflationary environment, interest rates go lower, and when interest rates go lower, the best signal for gold is not the dollar. That's a misconception by a lot of folks. The best signal for gold is low interest rates, right? And in a deflationary environment, that would imply that interest rates are even lower than where we are now. So the signal being interest rates would be even stronger for gold, right? So I think this is actually one of those interesting dynamics where gold wins no matter what. As long as interest rates don't shoot through the roof, and I mean, and what are the odds of that at this point, given all of the Fed stuff? As long as interest rates don't shoot through the roof, I think that either an inflationary environment or even a deflationary environment is actually good for gold. Thoughts on why the Aussie dollar is ripping higher? A lot of that has to do with China. So let me show you this. The Aussie dollar is essentially a proxy for China, right? It's their closest trading partner. They um, basically just think of it as a proxy for China. A lot of the reason that the Aussie dollar is going up is what's going on with the dollar here, right? So we looked at the dollar via the DXY, and in general, the dollar is getting weak against almost everything. The euro is climbing, the yen is climbing relative to the dollar. The Aussie has made some big jumps relative to the dollar, and I was actually going to pull up a chart of China. It's actually not too important. I can probably just answer the question, and the answer to the question is as things improve around the world, in terms of um, expectations, as things improve around the world, the higher the commodity prices go. So as you know, oil has been doing well lately. Copper has improved quite a bit. Stocks in general have improved quite a bit. The Aussie dollar tends to be your risk currency, right? So when risk on meaning people are buying stocks and commodities and commodity currencies like the Aussie dollar or the Canadian dollar or the Kiwi, then those tend to do very well. So you have a combination of two things. You have a combination of risk on, in that all these different things are moving up very quickly all at once, and then you have a combination of the dollar selling off. So you kind of have a double hit there on the dollar, and you have a double boost or a double catalyst for the Aussie dollar. Watch this though, or since you mentioned the Aussie dollar, that's actually one of the best indicators that I have for you to watch intraday. Where the Aussie dollar goes, I think the stock market goes. So it's actually a really solid leading indicator, almost as good as the Fang Index. I have to say that because I made it, but it's almost as good as the Fang Index. So if you watch the Aussie dollar, whether you watch the Aussie dollar, the AUD USD pair, or you watch it with the 6A contract, doesn't matter. If you see strength there, chances are that stocks are going to do very well. Hey, good to see you, Joe. Thanks for stopping by. Thanks for being here, Judy. Jonathan, hope that answered your question. Alex Wolf, aka Cookie Monster. I recognize the picture. Thank you for the comment there, my friend. Why is the market going up? I'm going to choose to read that as sarcasm, Cookie Monster, because I know you. Now, if you're not being sarcastic, let me know. But I think you know the three-letter answer to that. Here, I'll since it's a three-letter answer as to why the market's going up, I'll give you two letters. We'll play Hangman. What's the missing letter there? If you can answer that, that's why the market's going up. You have a question about butterflies. What's a good strategy to adjust them when your price blows by your target on the day of expiration or a few days before? Had an 850 pin on Tesla. Well, James, really the only thing that you could do in that situation when you have a butterfly and it's about to blow past your strike is really to break it apart. I mean, if you're asking for an adjustment for your fly, then you'd break apart you take off one of the short strikes and you take off the you basically here's the way it would work. And we want to keep these questions topical, but I will answer this one since I already started. With the butterfly, you're going to have two contracts that are short here, right? And then you're going to have a long and a long up here, right? And that's what creates your butterfly. When it goes above your center strike, right? So when it goes above your mid, you're starting to eat it on this one, right? So you're starting to eat it on the fact that you sold two in the middle, because you're short. You're essentially once it gets too high to the top side, you actually end up with negative deltas, which is probably not what you want if you were trying to be long. So the adjustment that you would make is either A, open up another fly higher up, or B, you could sell it. Well, you could sell a put credit spread against it. So you could leave the butterfly as is, and then sell a put credit spread against it higher, right? So that you could sell a put credit spread up here, and then you take in a credit, and that should help balance out the loss on the butterfly. The alternative trade, and I don't know if I could recommend it, but since you asked, if you start off with a butterfly structure like this, and it starts to blow past your center strike, or you just want to make it more bullish, what you can do is just close out this part of the vertical, right? Because in reality, you have two verticals here making your butterfly. What you would do is just sell or buy back one of these and sell this one. And then guess what? You now have one down here that's long, you have one here that's short, and you just have a straight up vertical at that point, right? You no longer have the two short, which is what's causing you problems. And then you just end up with a vertical there that has no upside risk. This thing could go to infinity and you wouldn't care. So you could fix it that way by just breaking apart the fly. I don't know if I recommend that. You really want to know what you're doing when you do that. The alternative way to do it is by opening up a put credit spread higher than your fly so that you can take in a credit as the fly starts to go against you because it's going too high in the other direction. Thanks, Steve. Thanks for being here. Thank you, Ms. Gamble. What's the symbol for the dollar? The one that I was looking at was the Dixie, so it's the dollar index. Um, Money sign DXY. The other one would be, this is probably the most pure version of it, and it's just looking at the dollar USD. So either one of those two. Keep in mind this one is inverse. Yep, it looks like you got it. All right. Somebody commented on my bouncy ball. I have to go back and read that. Yeah, if you're not sitting on a bouncy ball, I don't know how you're trading. Golden. Yeah, I got suggested to use a bouncy ball. So that's what I got for you guys. I think that wraps it up. I hope this was helpful. Basically, I really just want to make sure that everyone kind of is on the same point. We didn't just talk about random things today. Everything that we talked about is big picture, and everything fits together really well, right? So we looked at the cash markets first, which is what most people do. I suggest you, if you don't do this, add the futures to your trading as well. You don't have to trade them, but you have to know what they're doing. We looked at the cash, we looked at the futures, and there's a nice synchronicity there. Then we looked at the dollar and we understood its effects on emerging markets and the effect that it has when it kicks back to us in a positive way. Keep in mind, the market likes inflation, and stocks do too. Then we looked at VIX um, to try to understand volatility. That was the only one that is giving a little bit of a yellow light. But keep in mind, I gave you the levels on VIX, 27, 26. And if you start to see those break, I think we have to just lean into it and go to the long side. And then lastly, we looked at the Fang Index, which I showed you guys was right over here. And I'll leave you with this, I guess. This thing is back at an all-time high. If you would have told me, and I think anyone in the world, if you would have told them that we would be here on stocks, we'd have this kind of crash, and then we'd end up right back at the all-time high, and then have a setup to make a new high under it, I don't think most people would have believed you. But here we are. So a lot of things are lining up here for continuation. Always mind your risk. Always mind your risk. But a lot of this stuff looks pretty decent here. And if you guys have any questions for me, let me know. Sam@simplertrading.com. I hope to see you in the room tomorrow. And if you have any questions for me, let me know. Thanks for being here, guys. Very much enjoyed speaking with you. And I'll see you for the next one. Have a great night, guys. Cheers.